Good morning. Can the Bank of England bring rising prices under control? It's expected to hike the cost of borrowing for the third time in a row today, taking interest rates back up to pre-pandemic levels. I'll explain the impact for borrowers and savers.
16 minutes past 6. Let's talk about the Bank of England. Expected to increase interest rates again today for the third time in a row.
Yeah, Ben's got details on this one. All of this at a time when so many people are struggling with household bills.
Yes, and that's what makes it such a tough call for the Bank of England. You could raise interest rates and try and control rising prices, but you've got to be careful not to put the brakes on people spending too much, which would slow down the economy. A real delicate balancing act that they've got. Good morning. Here is the problem. The cost of living is rising at its fastest rate for 3 decades. Prices were 5.5% more expensive last month than they were a year earlier. Remember, that is an average, so for some things, the rises were even higher. And experts think the worst, unfortunately, is yet to come. Inflation could go above 7% in the next few months. And to put that in context, the Bank of England target is to keep it at just 2%. So we are way off that. There are a number of reasons. As economies woke up from the pandemic, fuel prices, material costs and the supermarket shop all went up. Now, war in Ukraine is pushing energy bills even higher. And the issue is wages just aren't keeping up. In fact, they're going down in real terms at the sharpest rate in 7 years. And households could be £1,000 worse off this year. These shoppers in Corby told us about the pressures they're facing.
It's horrendous. We've got a family of 6, so, just to even go and do some shopping, the price has gone up tremendously at the moment. And obviously, diesel car, you're really having to rethink things at the moment.
I have noticed that everything's increasing everywhere we go, but yeah.
Especially the petrol.
Yeah.
Yeah, and the food.
The supermarkets, things are increasing.
How are you finding that, though? Is it?
It's a bit tough, really, isn't it? It's a shame. We've just got to be careful what we do now.
So the big question, how do you help people out and control these rising prices? Well, one option is to put up interest rates. That's the amount that you're charged for borrowing money. Now, the idea goes like this. Higher interest rates discourage borrowing and spending. They encourage saving and then slow down the rate of price rises. If rates do go up later, it will be the third increase in a row since December, and it will take them back to pre-pandemic levels. But historically, well, they'll still be pretty low. Before the financial crisis in 2008, 5% was a more normal rate. Now, if they go up, it would be bad news for anyone with a so-called tracker mortgage. A rate rise today could add an extra £25 to the typical monthly repayment. But this isn't a simple decision. Some experts are worried that by trying to deal with rising prices, it'll stop people spending and stop the economy from growing at a time when a global recession is still a big risk.